Hello and welcome to our Yardi Matrix and Commercial Edge Industrial and Office Outlook on May 13th, 2021. My name is Megan Furr, your producer for today's program. We are joined today by our host Jeff Adler and Peter Kolozinski. Our program will run about an hour and we hope you can stay with us for the entire broadcast. We want this to be an interactive conversation, so please feel free to submit questions in the Q&A icon at the bottom of your screen, and we will try to respond to your messages while covering relevant topics. If we don't get to you, please contact us afterward for a more detailed answer. A recording of this broadcast and accompanying slides will be available after the program. Please note that what we discuss today may or may not be relevant to our situation. Please read the disclaimer carefully and consult your tax and investment advisors before making any decisions. Now, I am pleased to welcome Peter Kolozinski, Senior Manager of Commercial Data at Commercial Edge, and Jeff Adler, Vice President of Yardi Matrix, to our program today.
Hi, everybody. Thank you very much. This is Jeff and Peter. I'm glad you're able to join us, and I'm just going to put myself off a video so we can all focus on what's really important. We'll cover today industrial and general office. We do have a lot of coverage on life sciences and medical office. We'll do that separately in a pre-recorded session, and we'll later distribute that to everybody. Also, today in today's discussion, we're really just going to focus, for the sake of given the time we have, on the fundamentals of industrial and office and what's going on. We're not going to cover, as sometimes I do, the kind of macroeconomic picture, inflation and growth and such, and even local political issues. We can cover that in the Q&A, but we're really going to kind of dive into the fundamentals of each of these two really amazing asset classes and kind of work our way through that. So let's kind of get into it. As here at Matrix and in Commercial Edge, we like to give you the answer first. So I'm going to do that right now. I'm going to give you the answer, and then I'm going to take you through how we got there. On industrial, demand is really strong, continues to ride a whole bunch of tailwinds. Supply is projected to just kind of cover up with demand, and as a result, rents are rising in just about all the markets, and even at the national level, vacancies remain low and relatively stable. Strong fundamentals, lack of available space for new development, and also the cost of new development, driving up industrial valuations for properties themselves. I'm really not concerned about that this is some kind of bubble. We do believe industrial has rather durable fundamentals, both supply and demand. There'll be some rebalancing, and the issue there will be really fundamentally around your rent growth projections and then kind of your inflation assumptions, and those are kind of issues that you'll be dealing with in industrial. On the office side, this is a much bigger set of unknowns. Office vacancies are up across the board, and for different reasons. There's demand shocks as well as some supply shocks on the shorter term. The recovery is really, based upon what's the future of work, and we're going to go through some models we've begun to run about what that looks like, and have a deeper discussion around that, because that really is the nub of the issue at hand. We do see significant through the Commercial Edge listing engine an increase in sublease space. And it is a concern. It's a concern that we'll kind of walk our way through. And so while we do think office in some form eventually recovers, and there is a role for gathering, the question is how long and what does that look like? And we're going to spend a fair amount of time delving into those issues. So first, let's take on industrial. So what's the punchline here? The demand's strong. Industrial rents are performing well, vacancies low, rents and property values are rising, new supply is increasing, but you'll see kind of at a manageable rate. So there's quite a bit of nice balance here, which is just providing an incredible tailwind for industrial. So first, as an area of coverage, we cover 107 markets and 14 billion square feet of space in the industrial realm. So just about everything you'd want to cover. When we kind of get into what's been the sort of the true biggest tailwind, it was obviously e-commerce. It grew 30%. E-commerce sales grew 30%. There had been an annual, kind of, as we covered in earlier webinars, there had been a e-commerce penetration that had been kind of clocking along, but really it popped. that's been the biggest issue. Basically a 35% pop in e-commerce sales. And so while there's a little bit of rebalancing going on, even the trajectory I think will continue. There has been a quantum shift in consumer understanding of what they can do and what they can expect to do, and as a result, time they don't have to spend buying stuff, they can redirect to other purposes, and that is kind of enduring. There'll be some rebalancing into some retail. Retail as an experience will come back, but this looks like a continuing durable tailwind. Now, when we look inside of commercial and industrial, obviously the single tenant e-commerce spaces get all of the kind of the headlines and the news, but there's quite a bit. Yeah, Peter, you can say there's quite a bit of multi-tenant activity going on, right?
Yeah. So the one thing that jumped out here to me was just the prevalence on the coastal markets of the multi-tenant you see in Fort Lauderdale, all through Florida, the West Coast. One thing that stuck out, I think, was Austin being that high. I feel like as we continue to see more supply delivered in Austin, those numbers will shift away from multi-tenant, more owner-occupied, more single tenant. Again, you mentioned single tenant prevalence, Jeff. Inland Empire, obviously, at over 41% there. That's a number. And then I think two markets that stuck out as well, Dallas and Atlanta, where they would be shifting more towards that single tenant percentage as more stock gets delivered.
Okay, so but we track that, and so it's important to understand the dynamics of and the owner occupied is also a fairly significant amount of the stock, which has not been up until now very investable in order to get a position, and I think that actually is changing.
A lot in the Rust Belt and the Midwest, I would say too.
Yes, exactly.
Detroit.
Now, one of the things that we did was really to try to identify a demand model to try to figure out demand and supply. We have a pretty good handle on supply. We really wanted to get our arms wrapped around demand. And so we built a model that actually lays out, what is the demand drivers. And if you look at that, it's a simple, multivariate regression model, but it does give us a pretty good idea of what overall demand looks like. And it's driven by these five variables. The two most powerful one on the R squared being retail and wholesale inventories and housing starts, but the other ones are statistically significant and meaningful. And when you look at that, what that means is that let's say you're going to see an increase of, if the trend line had been 3% growth in demand, the short term would be sort of a slightly higher number off of that 3%. Same thing for 2023. So you do see an increase in demand requirements based upon these variables. And this is, we just map this, graphed it to show you that there is a pretty darn tight correlation between these five variables and therefore demand and supply of industrial space. So we feel pretty good about this at a national level. We'll be spending some time over the next several months trying to see which ones are also meaningful at the regional level. When we go back to our supply forecasts, and we have a fairly extensive, detailed process of tracking the new supply pipeline and projects that are in perspective and planned, which is permitted, and then that plan is a pre-permit and then under construction, and we model all that out. We have a pretty good handle on what we think the supply will look like. I feel pretty good about 21 to 24. 25, 26 seems a little light to me. Given the demand drivers that are happening, I would expect that we will continue to see about 3% overall stock, about 250 odd million square feet a year. And just for context around that, Amazon absorbed 100 million square feet alone last year. So that's kind of a notion there. And we update our forecast every quarter, and we did see a bit of an increase in the second quarter versus first quarter forecast. We track that, and then we update it all the way through. When we get down to the market level, here's where, when you look at this as an overall, the bar is based upon total square footage, and then the number is the percent of total stock. And when you look at those numbers, like they don't scream out to me as like crazy numbers, right? In terms of,
No.
yeah, 4% of Inland Empire. Inland Empire is a lot, obviously, because of the movement of goods out of China. It doesn't seem crazy to me. Peter, do you have any more color
Yeah,
that you can share on that?
some ones that stuck out for me would really the interior Midwest and those growth markets. So Kansas City, Columbus, Indianapolis. Kansas City specifically, you're looking at over 4% annualized growth. There's low vacancy there, but there's huge projects that are coming online. So right now under construction, there's an Urban Outfitters distribution center for 800,000 square feet that's going to be delivered. Some big projects in the pipeline. You're looking 5 years out. Logistics Park, Kansas City, LPKC they're calling it, but it's 14 million square feet of space that they're looking to deliver. Just a tremendous amount. Same thing, similar in Columbus. 4.1% annualized growth we're looking at. Again, tight vacancy. But around the Rickenbacker Airport, you're looking at 1 million square foot project right now in Commercial Point. There's the Rickenbacker Logistics Park. Hasn't started yet, about 5 million square feet in prospective delivery that we're expecting. Indianapolis, too, I'll point out quickly, similar 3.8% annual increase. Walmart is building its largest fulfillment center in the country right now, 2.2 million square feet under construction in Hancock County, just east of the city. And then larger down the line, looking at projects, All Points at Hanston, it's about 7 million square feet expected to be delivered and come online in the next couple of years.
Super. So I take away from this is a market that is overall in pretty decent balance, even at the sort of local market level, not in addition to the national level, and that players are fairly rational. And if there is there's need for it, but there are also sort of there's true customers behind that need, not as much spec. Now, when you go to the smaller markets, also note that while the bars look bigger, we're also talking about the max being 6 million square feet. So it's a much smaller number. And even there, the percentages of stock being added aren't crazy, relative to the growth in e-commerce and the small kind of initial stocks that people are dealing with. So again, you look at that and you say, that's not, this market's okay. We actually provide a little more detail here, not only in the one that are the summary of the forecast, but the pieces of that too. So when we look at the total new supply pipeline, obviously you have a lot of prospective deals that are early stage. The conversations have started. Planned is when a formal, proposal has been, put in, and before permit's been issued, and obviously under construction is when dirt's getting moved. And there are some towns here that look like, wow, there's a big percent of stock.
Columbia, right?
Yeah, like, can you give me a little color on like what's behind that?
So I had to go back and check this just because the 236% increase, stood out. But ran back the numbers, and really South Carolina in general, outside of Columbia as well. But Columbia, you have a project, I-77 mega site, 9 million square feet. There's a project, Sandy Run International Industrial Park, 6 million square feet. Blythewood Business Park, 5 million square feet. And all of a sudden that 21 million square foot number doesn't look so crazy. You start adding that up.
But there's also real activity that's driving the need for that space, right? You have the port, you also have trucking and distribution of goods throughout the entire Southeast. Which
the Savannah, Hilton Head, Greenville, all right, but Savannah and Greenville have a larger amount of stock currently, right? So that add-on that you're seeing in Columbia makes that number so large.
Okay. So anyway, we have that level of detail, and so as an investor or in the leasing side of things, look at what's happening, you have much greater visibility. And when we look at that in terms of as a percent of a total, right? About 57% of the space under construction is really just in the top 20 markets, and you see that top 20 being in the 57 to 59% range. And so these are the biggest markets. Memphis, Philly, Kansas City. We already talked about some of these already, but again, we kind of break that out. Why don't you go into the Dallas?
Yeah, Dallas. I mean, there's 9 projects right now, 1 million square feet or larger, under construction in Dallas. So this logistics hub in South Dallas, there's 2 individual buildings, 1 million square feet being delivered there. But that South Dallas corridor has seen a lot of growth and continues to have a lot of under construction properties being delivered.
Cool. And this just as an example, these 10 locations within Amazon are collectively 27 million square feet alone. And they're all obviously large distribution hubs. We have seen some conversions of malls into distribution hubs, as well as brand new construction. And we do track those conversions as well in our models. And we do have the retail data on the malls to be able to sort of identify those candidates as they go through. And
real quick, Jeff, just go back
yeah,
to the Amazon slide.
sure.
You know, we talk about the eventual exit strategy, and recently, last month in April, you know, we've seen 2 six-figure deals on fully leased Amazon buildings. One outside of Albany in Rensselaer County, one in Tampa, Florida. Go back a little bit further than that, and you had a project in New Jersey, 10 Edison, 900,000 square feet, sold for $247 million in January. So you've seen these Amazon leased projects, you know, the exit of them be
very attractive investments, right?
Commanding a premium, yeah.
Yeah, exactly. And so when we kind of took it like at this is in our supply forecast, you know, most projects in industrial kind of move very quickly. There are some jurisdictions where it takes longer, and we account for that in our supply forecasts. When you look at kind of fundamentals, right, you can kind of see here that the average rents, you know, were negative coming out of the GFC, but they've kind of clocked in at a kind of a 5% average, you know, annual clip across the country, and vacancies will have come down and kind of stabilize, and that's because the new supply pipeline has ramped up to kind of keep the overall numbers. Now, this market looks like a market quite well in balance. And as we've kind of mentioned, having some significant demand drivers, you know, so that's kind of where we're at. And I just saw the chat. Yes, this entire webcast will be recorded and distributed to everybody who registered as well as attended. So don't worry about taking notes, just enjoy the conversation. When we look at vacancy rates by market, you know, you can kind of see that the coastal market's very, very tight. The port market's tight, and then Indianapolis, you know, also really tight as a major kind of Midwestern distribution hub. But even the ones that are sort of doing quote unquote bad really aren't that bad, right? You're looking at Denver at 8% vacancy. That's not that bad.
Yep.
And so this market, even when there's a little bit of problem here and there, really is really quite tight. Of course, there are markets that are tighter than others. And when it comes to rent growth, you can see that same kind of a pattern. The West Coast, you know, this is 8% in-place rent growth for Inland Empire. That's just crushing it, right? But even the coastal markets and Nashville, some areas that are doing incredibly well from a rent growth perspective. And if you also lay on top that I'm just looking at the rents, and really there's the recoverable expenses of about $1.50 a square foot, usually cover the entire expense load of an industrial facility, and it has relatively low capex. So that rent growth flows directly through, all the way through to NOI and then to cash flow. So it's a very attractive investment. And here's where we kind of walk this through here, is you're looking at Inland Empire, you know, stellar performer at 8% growth in place rents at a 2% vacancy, where, you know, the average rent was $648, but the lease signed over the last 12 months was $766. So a quite positive lease spread. And there are some markets that are kind of the other way around, but even the ones that aren't doing that well are still doing really well. If the national average of in-place revenue growth, in-place rent growth is about 4%, even the ones at the bottom here are growing to 3.5%. And again, these are very, very, you know, kind of tight vacancy rates. So very, very, very attractive, you know, performance. And there are a few that aren't doing quite as well. But again, you know, you got to look at this and saying the sector is quite well. We do have obviously the data at the market level and even at the sort of comp set level and at the property level. But this is a sector that's performing extraordinarily well. Then when you kind of switch this into as an investment, you look at the cap rates. Now, understand multifamily has the implicit or explicit subsidy of the GSEs that could have, you know, move its cap rate down because the debt costs are lower. But among other commercial assets, industrial is extraordinarily low, driven by these great fundamentals. And really, it's just a question, I think, when you're investing, in industrial, and there has been a tremendous institutional investor interest, is what do you have to believe in terms of rent growth and your exit in order to make the deals work. But clearly, it is a multifamily and industrial are the two kind of favorite asset classes among institutional investors, apart from discussing niches like self-storage or medical office or life sciences and such. And we see that, just look at these sort of uh, unlevered, this is unlevered compound annual growth rates in valuation per square foot. Just outstanding kind of performance in industrial. Now, what is interesting now, and we've seen begun to see this, is if you're an institutional investor and you're having a hard time putting capital to work, well, knocking off some of the sale leasebacks, right? That stock of 25-30% of the inventory that you could basically get into through a sale leaseback is a very attractive entry point. You've seen those transactions explode.
Big jump last year, Jeff.
Yeah, big jump, right? So that makes a ton of sense as an entry point for an institutional investor trying to sort of find a way. If you can't get development sites as well, and sales of marketed property have gone up so much, a great way to get into the market.
So some examples there too, if you don't mind, Jeff. Just
sure.
Link Logistics. They're buying the Iron Mountain portfolio is 13 different individual sites this past December for $350 million. You had Kohl's working with Brookfield. So it was a seller leaseback on 2 of their large distribution hubs in the empire, right? So it was over 1.5 million square feet, $195 million transaction. The other part of these seller leasebacks I'm hearing more and more about is the food industry. So a company called Cafe Valley, 2 deals, one in Marion, Indiana for 35 million, one outside of Phoenix for $42 million. And then what I would say is some of those high profile ones, the majority are that $5 to $15 million range.
Yeah.
And you've seen it across the spectrum, right? Food manufacturing, distribution, processing, printing, bedding, even breweries, right? Taking advantage of getting the capital from these transactions.
All right. So you can kind of see just the activity level going on in industrial and the range of, I would say, creativity that are happening. So you look at this and you look at the values. These are just 3-year CAGRs, just outstanding rates of return for industrial assets for as an investor. And a few have seen decreases there, but really, quite small. And I think if you provide some level of understanding of the value creation in the market that you're playing in, you got a pretty decent bet of doing quite well. And not surprisingly, it's attracted a tremendous amount of institutional investors in trying to put capital not only into the public REITs, of which there are a few, as well as a whole bunch of private vehicles that have been developed. So just a lot of capital, a lot of interest. And I got to say, like, it's hard to sort of like what's the problem, right? The industrial demand looks good, supply is growing but not out of hand. Rents are rising, occupancies are tight, vacancies are low, values are rising. Yes, there'll be some rebalancing toward services, and I think maybe long term one might think about if there's retailers who eventually go to some sort of third-party logistics providers, and there's some potential consolidation down the line. But as you're moving more towards consumer demand being more driven through e-commerce and delivery, yes, retail still is on-site retail is the most valuable channel for a lot of retailers. So we're not saying retail is dead, but it is a lot of space is going to be repurposed in retail, and you will have a smaller footprint of what denotes high value retail and experiential retail, with a lot of the workaday needs of life handled via industrial and e-commerce and delivery, and omni and multi-channel. So great asset class.
Hey,
Now, when
Jeff,
we, yes,
before we move on to office, we have a
sure,
question regarding to industrial. So
sure, fine.
do you expect industrial construction projects to push further into secondary markets and potential tertiary markets over the next few years as the availability of permitted or industrial suitable sites in primary markets can be difficult to find?
Yeah, I do. And then one of the value of having, so many markets in coverage is
Yeah.
that one would expect as, both the availability and the cost, increases, you're already seeing sort of overflow into markets that can serve as secondary markets. Now, they still have to be along a highway. They still have to be within driving distance. I think Jack, who's a bit of a specialist on this, I'm going to pull him in every now and then. Jack Kern, our head of research, 550 miles from a population center is about the extent to which you can drift. But there is still a significant opportunity for I'll call it secondary and tertiary markets to grow. And just like we saw in some of the Columbia and in South Carolina, right? We saw
In the
some
Midwest
markets have
too.
explosive growth there. Yeah.
Yes, Indy, Columbus, Kansas City, right? They're all
Right.
within the day's drive.
Exactly.
Great, thanks.
And I think it was one other question about construction costs and long lead times to get those materials, and so that is definitely an issue, right? If you look at industrial, a lot of it's concrete and steel. I think it's less impacted than, let's say, by other asset classes by lumber and other areas, but it's very likely that construction timelines will be stretched out. Also, there will be a rebalancing and a repenciling of deals to make them kind of work. However, with rents growing at the extent to which they are growing, I would think that it will be less impacted than other asset classes on construction costs. Good enough. Well, let's move over to, I would say, I think if industrial is just this story of just uninterrupted prosperity, a fundamental office provides, I would say, a much more intellectually challenging environment and also a much more treacherous environment. So vacancy rates, and this is obviously driven, all of what we're going to talk about here is COVID and the implications of COVID of the movement of work away from the office, centralized offices, and this notion of what comes back and how it looks like. So the fact of the matter is vacancy rates have climbed and continue to climb to a certain extent in San Francisco and Seattle. I think things are beginning to level out. We've seen that in both in sort of the vacancy rate that we're tracking. Things have begin to level out. Vacancy rates are climbing in Austin and Nashville, but that's more of a supply issue. And there really is some differences here in markets between supply and demand in terms of their dynamics. And so we really need to draw a distinction there. Listing rates really haven't moved a lot, but most of the action's under the covers. I mean, you don't really see in office, it's not so much the listing rate as it is the TIs, the leases, and the lease concessions and the free rent. That's when most of the action kind of happens. But by seeing an increase in subleasing space, and it is widespread, though it appears the rate of growth is not necessarily accelerating. It is a real concern, and it does weigh on the total kind of absorption capabilities. And fundamentally, and we're going to get into this, right? What does a return to cities, what does work look like? That fundamentally is about the pace and direction of what a recovery looks like. And it's going to be a much different industry than when it entered. We do have a tremendous amount of coverage, 120 markets, 8 billion square feet. So we cover the office sector in a very broad way. When you look at let's just ground ourselves with some data here. You can see the vacancy rate nationally has kind of begun to level off. You see April and kind of leveled off in March and April. The number of active listings have grown significantly. So there's a lot of space out there. Vacancy rates at 15% nationally, have looked like they've begun to level off. But I would say this is the first salvo in what is likely to be a fairly lengthy process going forward.
Yeah, Brooke, when it comes to just the listings, if you want to go back to that last
Yeah,
slide.
sure.
Real quick from commercial edge standpoint. So across all our platforms, we have about 270,000 listings that we display. And we've seen a significant increase in a jump in the last couple of months and weeks in the form of inquiries that we send out to the brokers. So we are running at about 100,000 vetted leads that we send to brokers annually, which in the last couple of weeks, last couple of months, it's up to about 50%. So whether that's actually translating into more people occupying office, I'm not saying that, but there definitely is some interest and intrigue that appear to be
Right.
showing.
And one of the issues you kind of have here is there also could be price discovery going on, right? Like, okay, well, gee, I wonder what things are listed or leasing for, and if I'm going to sublease space, what's kind of the pricing? And so there's interest, and there's a lot of uncertainty, I would say, about whether that translates to actual demand, or is it a
That's fair.
reshuffling of the price point, right? Which I think, if you look at the change in expiring space that was renewed, right? There's a lot of folks in Seattle decided not to renew their spaces. But Portland and Austin, we saw an increase in there. But this is something we are tracking about, well, how much space, how many leases are expiring, and of those leases that are expiring, how many are actually renewing. And I would expect that there's a lot of, you're going to see a bunch of tumult and turmoil in this area, particularly in the more expensive areas, but also in some markets that are less expensive, that are sort of tech hub markets. But that's because I think the whole notion of the nature of work is fundamentally in play. Now, when we look at this, you can see just the increase, right, in the vacancy rate of some of these locations. This is stuff that you haven't seen except for maybe the GFC, in 09, 010, where you have, now a movement where you had some markets that were pretty tight before, that have just, got a lot of available space there, and in the high teens now. Where it was not the case before. And the change in asking rents is kind of, again, asking rents is kind of a more influenced by the quality of the assets being put on the market than they truly is an indicator of transactions, as we would say in other asset types.
It's definitely held steady, and I think our feeling is on the back end, the concessions seem to be in the form of free rent. So folks are keeping their asking rents relatively unchanged, but the giveaways ends up being on the free rent side.
Right, and I guess it's easier to sort of not have as much transparency, right? Have that a little opaque on the concession side. So the other part that I find kind of really interesting is, it's not just a notion of urban core. Like in apartments, you could kind of say you'd have urban core is a problem and everything else is okay. Well, here, not so much. You have vacancy that are higher in some suburban submarkets, right, than in urban areas. You also have some vacancy that's higher in urban markets, and Nashville would be an example of new supply. But so it's not so simple an answer in office than you have in some other asset classes. Again, because the nature of work itself is in play, and not just the movement of people. And so we graphed here, something that I was trying to wrap my head around, is how much do you have an increase in sublease space. So the vertical is the change in the amount of sublease space, and then how much of the sublease space is as a percent of the total stock of space, right? So for example, in San Francisco, it's now up to 3% of total space, and it's double what it was a year ago. And so when you look at some of these markets, right, I was a little surprised by Salt Lake City. Like, that's like a tech hub market. But again, this is a question of what's the nature of work look like. So this is playing out in a meaningful way where it's not so easy to draw simple conclusions, right? I think it's a far more nuanced and complex layout. And we even look at
tough to track. I mean, there's definitely a little bit of a shadow inventory, like in the Dallas and the Manhattan. They're probably a little underrepresenting what's actually out there when it comes to subleases, just because it's a little more hushed, I feel like. But
that's right. And then one of the things I wanted to look at was just, is it all urban? Is it all suburban? And there's a lot of urban sublease space, right? But there's also a fair amount of suburban. So we do find this, that there is a lot of the space here is in the blue connotes that urban is most of the sublease. But if you look at Raleigh, well, that's not true. Look at Tampa, Orlando. The sublease space, such as it is evenly split between urban and suburban, and also, by class, it is largely, kind of A and B, which is what you'd kind of expect. But so there's a lot of moving under the covers. And so now we're going to begin an exploration of work from anywhere. And I find that this is probably the most sort of problematic, and also the one where there's the most confusion and fogginess. So this notion of work is not somewhere you go, but something you do. There was some of this happening before, but it's been vastly accelerated in this sort of, global experiment here. And so the timing of return to office definitely varies by market. I will tell you, it varies by company, it varies by industry. Okay. And obviously, it varies to the extent to which public transportation and the school system is open. And those in some of the sort of international gateway cities have been very slow to open. Public transit use is still significantly lower than it was before relative to other global cities, particularly in Asia. And so it's coming slower. So prior to the pandemic, and again, this isn't necessarily rocket science, but I want to kind of get through this. About 5 to 10% of the labor force worked remotely. We think that that's probably 20 to 25%. That probably doubles. And so that's a slice of workers who don't come back into a location. And then there actually is what happens to everybody else, right? And so we do see some consumer data which indicates that the remote workers have moved out. We see that in Postal Service record data. They've moved to the suburban areas. They've also moved across metros to lower cost areas, and that also depends upon your age, and that there's more coming. Okay, and I think one of the key things I want all of us to keep in mind is there is so many things in play now about which company, which industry, which function within a particular company. Also, for that particular worker or employee, what is their living situation? Where are they in the stage of their career? Do they have more flexibility because they're a little more experienced? Are they in an industry that has really a talent shortage? I'd say elements of programming and development and technology. That if you're looking for a data point with and you have an axe to grind, you're going to find a data point. Okay, so I want us to sort of be really thinking through about the larger picture, and not focus on any particular anecdote, because I think that can very much lead us astray.
I think that's really important, that last part, Jeff.
Yeah, again, I've been reading a lot of what people are writing about it, and if you say, oh, what is their job, then I can sort of figure out what it is that they're saying and why they're saying it. So I don't have an axe to grind, and I have no dog in the hunt. Sorry about that. I don't have a particular dog in the hunt here. So I'm really just trying to get our head wrapped around what actually is happening. And so what seems to be emerging is, first, you have this group of workers who are truly going to be remote permanently. But for larger companies, there does seem to, for medium to large companies, it does look like 2-ish days a week kind of works. And what that then means is, well, what does that 2 days a week mean? What do you do with that? And you have to be, and I've mentioned it before, managers and companies will have to be now much more intentional, right, about why is someone in an office? What are they there to accomplish? Also, to have the sort of the technology to support reservations, and you have to know your densities and that sort of thing, and the teams. Why are they meeting? What are they there for? So it has to be more purposeful, as opposed to the default was everybody will be in one place and we'll figure it out. Well, now it's like, well, no, everybody isn't in one place, and you have to figure it out. And if you think about this 2 to 3 days a week, well, if everybody in the company is in the same at the same time, then your footprint fundamentally hasn't truly changed. It may be sculpted, but hasn't really changed. If instead certain teams meet in certain days, right? And so you can reuse that space in a hot desk hoteling fashion, then your footprints can sculpt down more meaningfully, even if you allow room for additional hiring. So that's on the medium to large size. Small companies, I would say the ones that are under 20 employees, may, and we have, again, be careful with the anecdotes, they may not need permanent space at all. In fact, co-working could be a very attractive approach to say, well, when I need to get my team together, such as it is, we'll go rent some space in co-working. We don't really need a permanent location. And quite frankly, a lot of my clients don't need to know that I have a location either, because everyone's now been used to this notion of remote work. And so again, that's easily 10 to 20%, right? It happens over some period of time. So again, you have a lot of this up for play. So, I think short term, you're going to see small levels of I'll call it sculpting, right? We have seen an uptick in subleasing. We will see a desire for more flexibility, shorter lease terms, minor space reductions. And this kind of grinds its way forward, right? As to what does a new work look like? And there's just the elements of what's up, of what's not yet known is rather meaningful. Now, if you look at current utilization of space, it's obviously even, Texas in the 40s, right, which is quote unquote, the best in the country, is a far cry from what you would need to have utilization be to make office, kind of work, right? And obviously in the core centers, it's 15 to 20% is incredibly low. And so it's helpful to understand the basic we're talking about. But remember, we're talking about what does it look like at the end game, because that's what the fundamental, you can see through, again, most people are paying their rent. Companies are paying the rent, so it's not a short term. And I'll harken back to a slide I've shown you before with that I think Jack Kern put together at Prius, where office changes in the economy hit retail and multifamily quick in the first year, and industrial lags, a year or so, and office lags a year or more, right? Because these effects ripple their way through and take time to ripple through. And when we start thinking about this, right, now we have to think about, for all, if you're owning a building, what are the industries of your tenants, right? So for example, and we think this plays out, not only at an industry level, but also inside an industry without a company level. So for example, in financial services, you've got big regulatory issues, big cybersecurity problems, and big financial risk issue about high risk portfolios or dealing. That's largely becomes office based. Government, I think, becomes a hybrid. There are certain, consumer facing components that go back to in person and stay there, and a lot of it becomes hybrid. And so we're seeing that kind of play out on the government level.
With JP Morgan too, real quick, Jeff.
Yeah.
They've put on 800,000 square feet of sublease space in New York City, 600,000 square feet in specific buildings, but they've made statements that they're going to shrink their space globally. But at the same time, they've committed to 270 Park Avenue headquarter building, right, which is 2.5 million square feet, supposed to house 12,000, 14,000 people in what they call flexible configuration. So they're committing to that, which is that's a big commitment.
And I think what we're sort of seeing it, and when I tease out the beginning we're talking about, is there will be some flagship locations, right, that become the core. But now the question is, a lot of the other offices that were satellite offices or sub offices or branch locations, that's where things get hinky. Okay.
Yeah.
Even in an industry that's committed to office work. Now we go to other industries, and I would say technology being probably an example, right, of a hybrid fully remote. And again, we have some examples of like Twitter and Square, which are like everybody works from home. Some were like, well, we want everybody in. But even Google, it says, well, we'll let 20% telecommute, and then it'll be like this, because if they lose talent, which is in short supply on the tech side, then, well, maybe they'll be a little more flexible than they otherwise would have been, right? Amazon saying we're office centric. So, and also I would say, even in technology, if if your technology components, right, are truly brand new innovative products, yes, you're probably going to get together, okay, because you need that personal interaction. But if it's accounts receivable, accounts payable, if it's maintenance of a technology or support or other areas, it's going to be a lot. Again, there's a lot, all the variables are in play, and again, it even gets down to the who the person's living situation is, their stage of life, their personal skills, their negotiating leverage, whether they want to be with people or not want to be with people. You've got a lot more at play here, right? And I think that's the point I really want to make. And a lot of this is at play. And remember, we went from a model where just about everybody went to some place 5 days a week, and that's not going to happen again. Right. And in education, we've seen that, for K through 12, in person. For university levels, it's going to move to more of a hybrid-ish model or mixed model than happened before. We cover that in student housing. So we began to sort of try to wrap our head around, okay, let's try to, build a model of some sort, just to sort of we can have a more thoughtful discussion about what this means as opposed to platitudes. And so we created, let's create a snapshot of the way the world was. Let's create some sensitivity, and we just use three kind of use cases here: 90% return, 75% return, 65% return, and then how long does it take with given hiring assumptions to get back to where you were, not even including the amount of new supply that's coming in certain markets. Okay, this is just getting back to where you were under some not crazy scenarios. And so the question we have here is, like, could we be too optimistic on occupancy here? Well, we're not even taking a look at new supply, which we will introduce later, but we're not taking a look at that. Are we too pessimistic? Well, understand that we're modeling this as if everything happens right away. And these things do take time. They take years, right? We know that 10 to 15% of the space comes up every year in terms of expiration. So even if we say the potential is some big number, it doesn't really get expressed right away. It takes time for that to happen, and it can be backfilled with some level of new hiring. So this is more to sort of, I'll call, put a range around this and sort of a focus of a discussion. So the first part here was like, well, what was the pre-pandemic world look like, right? So we came up with the square footage, the vacancy rate, the occupied square footage, the office using employment, and then some notion of square feet per capita or per worker as a notion of that, and just to get kind of get a model of that. And then we began looking at these different sensitivity analysis. And so my kind of view here is, the 75 to 90% range, it's probably somewhere in between there. But when you look at that as expressed, that's a meaningful number, right? Like, you're talking about potential vacancies in the 20s, high 20s, low 30s, again, expressed over some period of time, backfill with some hiring. But you have to look at this as there is a 5 to 7 year grind here about what's the nature of work, how do work and footprints get reshaped, what's the purpose of being together, which industry, which function, which team. All of that's in play. And to think that it's not going to have a fundamental reshaping of the workplace, what it exists for, what you do with it, I think you have to come to grips with that reality. And then we kind of model this back. And so all the point being here is it's a multi-year process. Okay. I think the DC number looks a little too low in terms of hiring growth rates. So again, I think that number doesn't quite make sense to me, but I think you're looking at numbers of years, okay, for this process to play out. Call it 3 to 5 years at least, plus new supply. This is a grinding process and a total re-evaluation, right? So if you look, Peter, any commentary on that?
Yeah, real quick, just to jump in. And I feel like one thing that stuck out to me was the tech company perspective throughout the pandemic was the long run, right? So some of the transactions that they were doing, Amazon purchasing the Lord & Taylor building from WeWork, right? That's a long-term thing.
Right.
Facebook purchasing REI's headquarters that they were having built. that's a long-term outlook that they're having. So
Right.
the fact that this is going to take a while to sort through, definitely.
And also I think it's important to kind of note, you have a certain large tech companies, right, that are well capitalized, huge cash flows, and they do grab headlines, and it is meaningful. But there's a lot of space, and there's a heck of a lot of businesses.
Yeah.
Right. And so when you're looking at how does this play out across the entire economy of the United States and eventually the economy of the world, right? Because this notion of where work gets done is not just a US issue, but a global one. There is a lot to have happen. Now, if you kind of see this, one of the things we kind of talk about is the notion of flexibility, right? And so, Industrious got taken up by CBRE, right? CBRE took a major equity position. WeWork has reconfigured its business plan to be really focused on flexible workspace for corporations. It's pulled in JLL to do leasing for it. The brokerage and management firms have taken a much more deeper position now in co-working and flex working.
Yep, that was the point I was just going to make, Jeff, where you see JLL partnering with WeWork. Common Ground, I think we recently released a statement saying that they're working with JLL now to focus not just on your hot desking. The mentality of flexible space is changing.
And this week, again, I think what we're kind of seeing is that there's a lot in play, and most of the major sort of service providers understand that and will partner and are partnering with major office owners, that there is a component here of flex space that's going to have to sort of be a bridge, right, between a company being fully remote, fully in person. It doesn't really know what it wants, can't really figure it out yet, or needs a bridge, and
Yeah.
that this bridge is kind of a meaningful component. And now with, I'll call it 15-18% vacancy, the marginal cost, right, the opportunity cost of putting in 2-3% of flex space is suddenly not that big a deal anymore, right? So an opportunity to sort of like manage this business model. And the point I would make is that even metros that benefited from migration out of, say, California, New York, or Illinois, they've still got issues, right? Now, Austin and Charlotte and Tampa, I think Austin, Nashville, Charlotte, for certain, driven by supply increases. Phoenix more by demand. But so it's not again, as I've mentioned before, it's not like there's a one size fits all explanation, okay, as there are in other asset classes. This is far more nuanced, and there's a lot more at play. And if you look at the amount of sublease space, right, there's more in play here, right? So there's major firms that are gotten big blocks of space that they put on the market, maybe for price discovery, maybe for flexibility. Savills, which is a tenant broker, they're looking at, there's a lot of subleasing activity that's going on. And so if you think about that, right, again, I find this interesting from KO Cloud, right? 40% of office owners and managers think like, yeah, I don't think the 10-year office lease is going to work, right? So, but that's also what the financing was about. That was the value proposition on the financing and investment side, was long-term leases, low exposure, credit tenants. And again, I think in the world of office, nothing happens fast. Okay, the changes we have seen for office are fast, but this tends to sort of work through itself over time. And so, to your point here, Peter, about major companies that are offloading space, right? So JP Morgan you discussed, but Yelp's a tech company, and yet there's some off-lease space. Pricewaterhouse, the financial one, so Salesforce as well.
Yeah, and I mean Uber in Dallas too, the recent building that they put up. There's a lot of companies you're looking at.
Right, and Uber and Lyft, you kind of have to say, well, their industries are under pressure, and so they're under financial pressure, and so they're a tech company, but they're also travel related, and so that has to kind of work its way well through. But Capital One's a finance company that moved to Tampa out of Richmond, right? And the 150,000 square foot of space that are sublease there, right? And that's quote unquote a tech hub, an emerging area that's a very desirable place to live. So
there's a lot more in play, and it's a lot more in play across the entire landscape of office, as opposed to maybe there's a concentrated pain. I think this is more distributed uncertainty. Okay. And it's not just people who work in an office, right? If you think about this, there also is a whole ecosystem of remote of service jobs and retail jobs that supported the cash flow and the disposable income that was expended getting to being at work and coming back from work. And it looks to me like that's also in play. That's being disrupted as well. Now, to a certain extent, a lot of these lower wage service workers lived in remote areas, and they may be able to get jobs that are closer to where they actually live and reduce and improve their quality of life, reduce their commute. But there's a disruption going on. And if you had a lot of ground floor retail in your major, office strips, office hubs,
Yeah.
those are at play. And we're only looking here, we just pulled some numbers on the other income. That's a percentage of the office building, not of the retail, right? That was next to the office in a separate location, right? So there's an urban core, or that's also in play here. And while it's not like super, significant in, say, in Philadelphia, but in elements of Philadelphia or elements of Los Angeles or elements of Miami and Seattle, it's a meaningful number. Again, when you're talking about the sort of pro forma assumptions of cash flow and the very low cap rates associated with office investment, a lot of this stuff's in play. So we kind of get to this notion of the future of work, and it's been a bit of a tour de force, and there's a lot more to discuss here. But I think the point I would make for everybody here is a lot more is in play. And if you think that it's just like the GFC, give it 3 years, everything's going to go back, it's going to be fine, everything's going to be great. I know there's some folks who believe that, but I'm not in that camp. I think the implications are meaningful and longer term. And we will, I think Class A flagship locations will probably do amazingly well. But this is an e-commerce moment. As e-commerce was to retail, COVID really is to office. And I think the emphasis that we'll have as we go forward is, okay, now that you've come to grips with the fact that something fundamental has changed, how do you deal with it? Because in every disruption, there is opportunity. And I think if you take the mindset of something big has happened, but you can find the areas of opportunity within that, then that is where people will succeed. And that, I guess, is the point I wanted to kind of make here. As we shift to some other areas, look, we do see new supply declining over time, but there's a lot of the stuff that's going to get delivered because, office buildings take time to get permitted, to construct, to deliver, even if they've been pre-leased. There's a larger pipeline. We think it does step down, but it is a consideration. And so we do see that while the forecast up a little bit from the prior quarter, there's still space that's going to get delivered. It's not crazy as a percent of the total stock, but it's more, so I'll call it insult to injury, right? It's just more stuff that's going to be brand new. And while the newest assets may kind of, get absorbed, it is more the issue of the sort of A to B plus assets that are sort of not super cheap, not the brand new, but there's a lot of capital invested in it that I think is in play. Okay. Same thing when it comes to small markets. You're not going to see a tremendous amount of new supply here, but that is more space than is maybe needed. Here we take a look at, we had discussed Austin having a tremendous amount of new supply. You want to talk to that, Peter?
Real quickly, just on Austin, you see the new properties that are under construction, the Indeed Tower, Block 185, which is leased to Google, 6 by Guadalupe, which is a large mixed-use project. And as you get into these other planned and prospective properties in Austin, a lot of the stuff tends to be mixed use. So I wouldn't be surprised either if you kind of see a reevaluating of what the end product ends up being. Did they have more of a residential component to some of these office buildings? So I think it's flexible, and then also would expect to see the timelines drag out a little bit as well, specifically.
And if you understand, like the reason these cities, right, Austin's been busting out. It's become the San Francisco South and Raleigh and Nashville. These were areas that are big tech hubs, magnets for employment. And the assumption was, well, they'll need office space to house them, all these new workers. That's the part that's in play. I love these cities from a perspective of in-migration and population growth and the multifamily side. But when it comes to office, it's not clear, right, that the space that was assumed to be needed will all be needed. So it's far more complex picture and a far more nuanced picture. Same thing when you look at under construction, the top 20 markets are 2/3 of space, and that kind of trivels through the rest, right? So it's highly concentrated
because of the life science projects that we have going on. So IQH is building a Fenway Center, which is over about 1 million square feet of space. There's a couple other projects, Cambridge Crossing, bringing on 2 million square feet of space, or 1 million square feet across 2 projects. But the life science sector in Boston is really driving.
Right, and life sciences is kind of extraordinarily hot, and there has been a shortage of space, and it's highly concentrated in about 12, 15 cities. We have a lot more to say about that, but you can see it ripple through into some of these numbers. But there also has been a dispersion of life sciences activity into other locations, and life sciences being lab work that you have to do, in person. That's not a activity that can be performed remotely. Right, you need to do it there, and so there's some durability, just like a medical office. There's some durability because of some of the experiences. Though I will say, in medical office, some of the routine work will be done remotely that had been done in person. But if you're doing a procedure, you still need space to do it in. So we manage the new supply pipeline and we evaluate it. It's far longer, it's far more complex, it's far more significant, but we manage those cycle times appropriately. And you can see some of the large projects. I mean, these are large blocks of space, and there's hundreds of millions of dollars invested in them, and they're going to get delivered. And then it's a question of how they get leased up and what displaces them. Right. So if you assume that, employment growth was going to like suck all this stuff up, no big deal, you have to think about, well, these probably get kind of absorbed in some fashion, but what about the space that they left? And then that becomes the issue. When we look at transactions, not surprisingly, the level of actual activity has scaled back. If you don't have to sell, why sell? What will sell will tend to be either more marquee locations. We really haven't seen distress in any way in office yet. Again, this is a slow roll process, and the banks have been quite forgiving with any concerns. So again, I don't think, so this doesn't surprise me. You see the same pattern, right? If you look at 09, 010, you saw transactions shrink, but not necessarily the price at which deals got done. We look at also on the transaction side, sales and it being in the tech hub versus the gateway, and also kind of values and index valuation, much more sort of equivalence. I think a lot of that is just because deals aren't getting traded, and so I think it's very hard to draw conclusions from the sales activities that I would say. Same thing with a spread between urban and suburban. You're just there is a lot of activity, but that had occurred in the urban areas pre-pandemic, and also the growth. But now we're talking about a little bit of a different paradigm. So I think a lot more is in play. So if you've taken away anything from this conversation, I hope what you will have taken away is that when it comes to office, office is now becoming a consumer product, right? And a product that's driven by organizational development. And that is far more diverse because of the nature of different industries, the nature of different companies within those industries, the nature of different activities within companies, and even to the point of different employees who have different needs, different spaces, different stage of life. You cannot assume that the way things were will be the way they will come back. Okay. This is a sector that is going to go through and is just in the beginning midst of a retching multi-year rethinking about the nature of work and how it responds to the nature of the emerging nature of work. I do think there are winners, but there's a lot more in play now. Almost everything's in play. What does a product look like? And if you own properties, you need to be saying, how do I get inside of my tenants, the companies, the cultures of those tenants? What social media networks can I use? What outlets? What LinkedIn groups? What social media groups? How do I get inside the conversation that's going on within my tenants' cultures to try to figure out which ones I need to pay attention to, which ones, how are their needs going to evolve? The consumer knowledge, the organizational psychology skills that are now going to be required in office is a quantum fundamental shift than what had been required in the past. Much like retail over the last 20 years has had to go through a significant rethinking. In my mind, this is one of the most exciting moments in commercial real estate, because this now becomes far more interesting as a consumer product and service, in addition to being a financial service. So anyway, that's kind of my takeaway. That's kind of the takeaway there. From an industrial and office perspective, industrial, I think you got a whole bunch of tailwinds. And it's basically finding the right deals to get done and the land to get done. Office, fundamental rethinking about the nature of work, and really also about the tenants inside either a deal you're going to do or your existing assets. You need to spend a lot more time understanding the nature, the company, and the culture than you ever would have needed to in the past. And you can't always just talk to the company's corporate lease administration representative. They're not driving the conversation. Okay, it is a conversation being driven by the entire culture of your tenants. And so I know we've gone over it a little bit. I really want to thank you for your time. I'm going to have to put up. I've got. We're going to go into this depth, far more in depth. I teach a course now at Harvard, the Graduate School of Design, where we go into these issues, and that's in late June. The lawyers make me put this up to make sure that all this stuff was copyrighted, and we always got to have the legal disclaimer. So I hope you found this conversation interesting. Again, we also cover multiple asset classes, so feel free to contact us for any of that stuff. And I want to thank you. So Megan, I'm going to turn it back to you to see if there's any other questions that we haven't addressed before I have you wrap it up.
Yeah, there's actually no questions. So Jack, Peter, is there anything else that you'd want to add?
Jack, go ahead. We'll bring you on
I'm
in.
sorry, I had a problem. No, this has all been really great. Thank you.
Okay, well, super. Megan, why don't you just wrap us up? And I want to thank you all for having joined us. Megan, wrap us up, please.
Great. Thank you for participating in our program today. We hope you enjoyed it and found the information and viewpoints helpful. If you would like to subscribe to any of our free research, please either log on to yardimatrix.com or contact us and we will add you to our distribution. A recording of this broadcast and accompanying slides will be available after the program. A special thanks to Jeff Adler and Peter Kolasinski for their commentary today. I would also like to thank Jeff Muth and Mary Chu for running the web program, and Maddie Harper and Claire Anholt for their contributions to the content. This has been a production of the Matrix Division of Yardi Systems, Inc., copyright 2021, all rights reserved. This concludes our broadcast. Thank you.